Over the last 18 months, venture capital has flooded AI with more than $2 trillion. OpenAI's valuation jumped from $29 billion to over $150 billion. Amazon committed another $50 billion to AI infrastructure. Apple, Tesla, Intel, everyone is pivoting hard. Elon Musk claims AI will eclipse human intelligence by 2030. Mark Andreessen says AI is the new electricity, and funds are writing checks faster than business plans can be drafted. But here's the open secret. The economics are broken. Startups are burning millions a month on compute and data, yet almost none are profitable. The customers aren't paying, the products aren't must-haves, and the operational expenses are unsustainable. This isn't just a gold rush, it's a phantom boom. Let me explain why the entire AI funding surge is built on quicksand. History has a brutal way of rhyming in tech. An innovation captures the imagination. Pundits proclaim a new era, capital floods in, valuations detach from earth. Then the clock strikes midnight. The tech is real, but the market isn't there. The monetization fails, the over-leveraged collapse, the wealth evaporates. It happened with the telegraph. It happened with personal computers in the 80s. It happened with the genomics bubble in the 2010s. It's happening now with AI. Not because the algorithms are useless, they're powerful, but because the business case is paper-thin, the costs are spiraling, and the hype has created a financial fantasy with no basis in reality. Let me lay out the evidence, show you the burn rates, and demonstrate why a reckoning is inevitable. Start with the funding. The figures are staggering. Last year, global VC funding for AI startups topped $150 billion. This year, it's tracking toward $250 billion. Add in corporate R&D and infrastructure, and the total investment surges past $500 billion in just 24 months. This doesn't even count the internal budgets at the majors, the talent wars, the model training, the energy consumption, just the cash poured into private companies and speculative projects. Who's leading the charge? Look at the startups. Anthropic raised over $10 billion in 2 years without a clear path to profit. Their annual revenue is estimated at $200 million. They are losing more than twice that annually just on compute. Their valuation is $35 billion. That's 175 times revenue for a company incinerating cash. Hugging Face, valued at $8 billion, brings in less than $50 million a year. Midjourney, one of the few with positive cash flow, operates in a niche market. The vast majority of AI startups have no revenue at all. They're pre-product, pre-market, pre-everything, except hype. Corporations aren't far behind. Apple has spent $20 billion acquiring AI teams and building data centers for their Apple Intelligence push. They've yet to monetize it beyond bundling it into existing devices. Intel is betting its entire foundry business on AI chips, investing $30 billion in new plants, while losing market share to Nvidia. Tesla's Dojo supercomputer project costs over $3 billion annually. Elon Musk says it's for full self-driving, a product perpetually 2 years away. That's $3 billion a year chasing a mirage. But here is the core rupture. What is the tangible return? Where are the profits? Because pouring hundreds of billions into a sector only makes sense if it generates durable earnings, and the earnings are nowhere to be seen. Take the entire generative AI application layer. Companies are building AI wrappers for content creation, customer service, and coding. The market is instantly commoditized. Margins are collapsing. Customers balk at paying premium prices for features that are becoming table stakes. An AI that writes emails or generates logos saves time, but businesses won't pay thousands per month for it. The pricing power is gone. Meanwhile, the cost to serve one query for a powerful model like GPT-4 can be cents. At scale, that's millions a day in pure cost for free users or low-paying subscribers. The unit economics are inverted. The cloud providers, AWS, Google Cloud, Azure, are making money renting the shovels. But even their AI service revenues are a tiny fraction of their overall cloud business. The gold miners are bleeding. The shovel sellers are doing fine for now. But if the miners go bust, the shovel sales crater too. Add it all up, $500 billion has been committed. The annual global revenue for all pure-play AI companies is under $30 billion. For every dollar of revenue, the industry has spent over 16. At that payback period, You need a decade and a half of flawless execution and zero disruption just to return the principal. Tech markets don't have that patience, and the disruption is coming. Open source models are getting cheaper and more capable. Custom silicon is reducing chip costs. The very success of AI technology is driving its commercial value towards zero. The bubble isn't coming. It's already here. It's just waiting for a pin.